Morning, everyone. This is Brad Matheny. Today's the 25th of October. It is Friday. There have been quite a bit of discussions related to my SPY cycle patterns, and this has opened up a whole new kind of well, let's just call it a topic, which is, what really is AI and what is the capacity of AI and what are the basic components of AI. So, now, again, I'm no AI expert. I'm not trying to tell you that I work for Elon Musk or one of these AI companies and develop, automated whatever. My focus over the last 25, 35 years has been trading and building trading. So I'm going to go through a simple analogy. We're using my QQQ daily chart and we're using two indicators. So price up here, let me get this settled. And then we're going to use stochastics and stochastic RSI. So now we have AI typically consists of, I'm going to try to make this as clear and simple as possible. Data, raw data, and then calc data. So think of raw data and calc data as two separate things. Calc data is a second layer of data that is calced by from raw data to attempt to create greater inferred capacity. So, for example, you could be measuring, uh, the weather. You could be measuring earnings. You could be measuring EPS. You could be measuring all kinds of things, and then you could have calc data. Raw data can consist of anything. Really, it can consist of anything data related. Calc data is attempting to develop advanced quant outcomes. So ideally here, you have the raw data, doesn't tell you much because raw data can tell you that earnings are going up or the dollar's going up or gold is going up or whatever. But in what correlation? What is the correlation of that? So I'm going to do other data. Okay. And then we have what is called inferred data. So again, inferred data is presumptive analysis, core analysis. So presumptive core analysis would be generalities. So let me put that in there. These maybe 60, 70, 80%. And I'm going to try to give you guys an example as we go. And then you have what are called anomaly. So inferred data, I think I need another R there. And then we're going to go into what are called outlier anomaly data, which essentially inferred or calced data that does not align with general data. So now understand outliers. Outliers are theoretically, the problem with an AI is that the law of averages is going to come into play, meaning you feed it more data and it's going to come to some general consensus that price is going to do what it does on an average normal basis. It ignores outlier data. So, giving you an example, I'm playing basketball. I normally shoot within a 10-foot or 12-foot radius or whatever, 8-foot to 10-foot radius of the basket. Okay, great. That's my normal. And if I feed it 2 years worth of data and it comes up and says, well, he's really good at the 4 to 6 foot range and moderately good in the 6 to 8 foot range. Okay, That's a general bit of data. Okay. But now all of a sudden I'm shooting from 15 feet out and I'm nailing 3 pointers. The AI is not going to be able to really interpret that because it's outlier data. It doesn't correlate with anything that's normal in terms of what its capability is. And if this is something that I don't normally do, it just doesn't know how to handle it because it's outlier data. It's imagine I get up and I go to work and I do whatever every day. So it's going to think I get up and I go to work every day. One day I get up and I decide I'm going to take a trip to Mexico and I go for 2 weeks and it doesn't know. Its training has no clue that this is something that I'm capable of doing and it doesn't know how to handle it. So these are what are called outlier data. Now, in real time AI, outlier data is processed and calculated in seconds. So it knows if I'm not going to work on Friday and all of a sudden I'm headed down to Mexico, it's going to determine that I'm not headed in the direction of my work. It's going to determine that something's different, and it's going to try to interpret that outlier data based on generalities. So it may not know that I'm going to San Felipe. It may know that I'm not going to work. It may know that I'm headed south on the 5 freeway, and it'll make all kinds of generalities. It'll be like, well, maybe he's going to the hospital, or maybe he's going to visit a friend, or maybe he's doing whatever. And those are things that generally come into outlier data. Now, the inference engine is the quantifiable model. So it is a model that attempts to identify the most likely probable outcome. Okay, so now an inference engine is designed to pick the most likely probable outcome based on all of this data. Now there can be more, okay? There are literally and inputs and calc data can come in any way, shape, or form. Okay, it really can. All of this can come in any way, shape, or form. Um, so I want to talk about my SPY cycle patterns. So, oops, here. These are these are daily, and these are, think of them as inferred knowledge, including potential outlier data to the best of my ability. But they do not predict or are capable of understanding news or news related data uh, in terms of specialty events. So hypothetically, we're in a rally phase today. The markets are going up. Everything looks good. Perfect. Wonderful. Great. But let's say something happens. All of a sudden, we end up in some crazy, Martians land, or or Europe explodes into nuclear war, or I'm just saying some unusual big event. That is something that my cycle patterns are incapable of processing and or predicting in general form going forward. So as I try to tell you, this is generally what price is capable and most likely to do, and most likely capable of performing given no external outlier data, no Fed speak, no sudden assassinations, no crisis events, no war. I mean, and it could even be positive. It could end up being that, something happens and the world all of a sudden has a happy pill and the markets rally 6%. I don't know that. I can't imagine that a happy pill is taken into place in my markets, other than watching price do nothing more than look at cycles, and Fibonacci and GANN and Tesla energy, mechanical resonance theory. Now, if you want to learn about mechanical resonance theory and as I mentioned, the secrets of 369, I've done a video on that to try to show you what's going on. But again, if you look at this data and you realize that an AI, and again, an AI operates, and let's call this AI operates in static or dynamic modes. So what is static versus dynamic? Static means that you're asking it to make a prediction on a fairly broad basis. Give you an example. It's early in the morning here in California. I'm up. Where is this? There we go. No, helps if I spell properly, huh? Okay, everything else looks okay. Anyway, static and dynamic modes. Like I said, I'm up. It's early in the morning. It's Brad. What does he normally do? Oh, it's Friday. What does he normally do? If I'm looking at it early this morning, what does he normally do on Friday? Well, he gets up, he makes his coffee, he checks the markets, he checks his email, and then he gets ready to do his videos. And he will be working till 2 or 3 or 4 in the afternoon, and then he'll go take some time off to go visit family or do whatever. So that is a static mode, meaning it is making a prediction that is my normal, most likely outcome based on fairly static data. Now, dynamic data is kind of like what happens with Tesla, with a Tesla vehicle in auto driving mode, or with the Tesla rockets that come back to Earth. These are capable of making, like autopilot. It's like capable of making real time decisions in instants, in fractionals of seconds, based on data that comes in. It still goes through every single one of these processes to get to where we are going. All right, I'll just type it in here. So it still goes through every single one of these processes to try to get to some outcome, but it's doing it in fractional seconds. It's doing it every, 2/10 of a second or faster. And it's taking in all types of data, even visual data, and it's processing it. And that's exactly what your eyes do. Your eyes don't process the data. Your processes the data. Your eyes just feed the data into a core construct, which is take the raw data, calc the data, infer the data, handle anomalies, and then infer some sort of an outcome. So it's very simple with vision. Raw data comes in as a picture. You try to calc the data. Is it day or night? Is it light or dark? Is it sunny or cloudy or rainy? Whatever. Is there any immediate threat? Is there, what are you looking for? What's the objective? That's going to be your calc and inferred data. And then outlier data is going to be things that are unusual. Outlier data, go away. Outlier data is going to be things that are very unusual. Hypothetically, are you falling? Is a tree landing, trying to fall on you? Are you sideways, falling out of an airplane? Whatever. These are going to be outlier data that's going to set you up and say, we have some sort of crisis, or we have some kind of a not normal type of environment. And then your brain, the inference engine, comes in and says, hey, we've got to handle this. And we're going to handle it in a way that is different than if we're in a normal type of activity. So, in this theory, let's look at this. Let's move this out of here. Let's look at this stochastics. Very short-term stochastics rotate up and down. And what stochastics is a measure of up and down price activity within a range. Think of it as glass half full, or three-quarter full, or one quarter full, or zero full. That's what stochastic does. Where is price within a 14-day high-low range? Now, the settings for this stochastic right now are 14, 1, and 3. So we're looking back 14 bars to set the range. Then we're using a 1 bar look back smoothing to see where we're at. So that means this is the fastest type of stochastics we can get. I mean, we can get it faster by setting this to 3. It would be all over the place. And then the D setting, which is the smooth version of the K, is smooth by 3 bars. So in this mode, if I look at this raw data, I'm getting the fastest cycle trends that I can. You follow me? So now if I were to modify this to something a little slower, and give me the ability to really see what's going on, I'm going to set this to 5 and I'm going to set this to 7. So now, in correlation, my understanding of indicators is that you want to keep roughly a Fibonacci type structure with regards to value. So when you think about Fibonacci structure, you have key elements, right? You have 0.25, 0.382, 0.50, 0.618, 0.75, and then 1.0. You also have the zero levels up here. So when you're trying to build an indicator and you're trying to build indicator settings, look at how I did this. 7 is half of 14. Hey, imagine that. Half. Right there. Okay, and 5 is roughly 2/3 of 7. Oh, 2/3. Oh, look, 2/3 right there. Oh, and then wait a minute. 5 is roughly 1/3 of 14. Oh, wait, 1/3. Oh, look, 1/3. A little over. You understand how I set this up? You've got a correlative Fibonacci structure within these settings. And I could modify these all I want. I could hypothetically go 5, 14, 7. And now look at how I get deeper pullbacks and correlation to trending. Now I'm going to draw a line here, a horizontal line on the 50% area. Try to get it right at 50. And I'll draw another horizontal line down here at 50. Okay, so now I come down here to the RSI of stochastics, and I'm going to do the same thing. Okay, so we have stochastic length. I will go 7, try to mimic what I did. 5, I think I did it like this, and 3, and RSI length 14, RSI close. Let me make sure I did that right. 5, 14, 7, so I did it wrong. So this is 5. This is 14 and this is 7. Okay, so now when we're looking at these indicators, okay, and we can put a moving average up here or some other value. So let's just stick with an EMA, double exponential moving average. Okay, and then let's go to and pick something like ADX, see if we have it, ADX, and we'll close. So now I'll edit the EMA. I'll make it a 40, make it a 25 period. Why 25 period? That's roughly a month on a daily chart, guys. That's roughly 1 month of trading. Okay, smoothing. Okay, I'll leave that there. And then ADX, we'll go ahead and we'll attempt to ADX smoothing, DI length, directional index length. So we'll set this to 3 times the 7 setting, and then we'll leave that at about 13, which is about, again, about 2/3. So this is the full value. This is the 0.618 value. And here we have with the directional index. Okay. So taking a look at this, make sure that we're getting where we're at. ADX doesn't actually do what I want. So let's try something else. I'm not trying to waste time here. DMI, directional movement index. Okay, let's try to come in here. Settings. And we'll go 21 and 13. And I may have to set this up. Visibility. Okay, so what I'm going to show you here is simple structure. I'll drag this out of the way. Simple structure, guys. Okay, really very simple. When stochastics is above the 50% level, like we have right here, and when the stochastics of RSI is above the 50% level, like we have right here, and when these are Booleans, ands, the directional index dx plus is greater than dx minus, you are generally in an uptrend. Now, we would then look for the final trigger when price gets above the moving average. We would then look to try to presume in AI that price is going to continue to move higher. So now understand that as long as we stay above this level and don't get into the downward cycle trend, we are then moving higher. Now we can see here all the way through this, we stay completely bullish until we get pretty much right here, vertical, giving us a downward cycle trend right here, giving us a downward cycle trend. And this is pretty much what general AI does. We're looking for conditional data and we're looking for general data. So this is trending, is what this is, guys. This is nothing more than just general trending. And then we'll go look to see that we are above the moving average and above 50 and above with the DXY. So there's trending again. Then we get a bit of rotation here, back to the downside, roughly here. Then we go back to the upside, roughly here. We stay all the way into the upside, all the way through here. There's our downside move. And again, I'm just picking general levels. Okay, we've got to get below the moving average, and these have to be below 50. Okay, these two below 50, and this here inverted, the gold above the blue. So are we getting early triggers? Yeah, I mean, we are getting early triggers here and here, but we were waiting for the moving average to come down. If we just look at the K value, we get a trigger right about there. I mean, not super early, but that's just looking at the fastest stochastic value. So now we look at the fastest stochastic value, we get into an uptrend, 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 and then right here, when DXY and moving average crosses above, we go back into bullish trending. And then we come into here and just looking at K and DXY and price right there. And then we'll come back over here to bullish trending as well. Now, from a standpoint of DXY did not go bullish until there. So again, from a standpoint of having all of these conditions in play, you can see that we generally catch trending very well, but in rotation and sideways rotation, we may not catch it. This was saying, hey, price is generally likely to go down. It didn't, it went up. Price is likely to go up. It did for a little bit and then went down. Then price is generally going to go down. It did for a little bit, then went up. Then price is generally going to go up. Okay, it's going up a little bit. This is what general AI is likely to do. Now you need to add the second layer, okay? And the second layer would be hypothetically a new layer of trending indicating that we will only be taking triggers, and I'll just do this here as a simple example because I know it works. CCI. So now we'll add CCI, and we'll try to remember that we are going to try to look to upper band is 100, lower band. So we'll set this to 80, and we'll set this to minus 80. And we'll set the CCI. Okay, so we're going to be looking to try to buy as long as we are above this, let's call it middle level. So I'm going to try to make it as easy as I can. And then we are going to try to pull profits as soon as we get below this level here at 80. So this is going to be our warning, get out. Okay, so when we start to see the rollover, we're going to look for two things: rollover of stochastics RSI and rollover of CCI. So we get a good solid buy trigger here. And again, this is daily. It's not a perfect system. I'm just trying to show you. We rally up, we get the pullback right there. We're starting to move this out of the way. We're starting to move into consolidation. We're below our pull profit level. We're below our cycling trend on stochastics RSI. This is where we want to pull profits and lock in some sort of a protective stop. Okay, so at this point, you would try to pull profits and lock in protective stop. Ideally, the way I would tell and advise somebody to do it would mean to look at recent gaps, which you have a gap here, you have a gap here, and try to maybe move your stop into that gapping area. We haven't broken out of the downward cycle trend yet. We're still bullish. Though we're looking for it to roll back up to the upside. We get a little roll here, get a roll here, get a roll here. We're moving back to the upside. And then we get into this weakening trend again. We would look to try to protect our stop again and pull some profits. Ideally, that would be likely in this area here, or potentially this area here. Where do we eventually get out? Well, we eventually get out right here. This move down with the close below this 50 or middle zero level gets us out of our trade right there. Okay, so this basically puts us into a get out right here, and then moves us right back into a get back in right up, 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 pretty much right there. So you can see how AI is capable of making these decisions. And what you're going to do with AI generally is you're going to get to these generalizations of trend, right? Or of outcome. Then you're going to go down and you're going to look for nuance. So this is the nuanced triggering mechanism. Now, it still relies on all of these other data facts, and we're using these and again, a good and function, Booleans, and, or nor. These are Booleans. And Booleans are how we build complex structures in code. We use either and, or nor. That's how it works. X and Y and Z, or D and C and B. So that's how it works. You're building structures with complex Booleans, which create complex logical statements. And again, this process is to show you that, the whole idea behind an inference engine is that it is capable of making general decisions. It is not capable of, there's my content. It is not capable of being 100% accurate. It can never be 100% accurate. It can make generalized and anomalized general outcomes or predictions, But unless it is 100% full real time and 100% functioning on core relatable data, then at best, this is my opinion, at best, you're going to be able to get maybe 96, 97% functionality and operational capability. There is no way that an AI system is ever going to get up into the hundreds or 98. I mean, maybe on average 92, 93, 94%. But just understand that there are outlier components, which is right here, that are going to happen that the AI is not capable of handling. So, no matter what you train the data with, there's absolutely going to be some outlier block of data that the AI is incapable of processing efficiently. It may move into some default mode, a protection mode, a go flat mode, a pull profits mode, or whatever, because the outlier data is unrecognized. But outlier data is where the systems will fail. And what I was trying to do is provide you some, idea of how this works. So when you look at my SPY cycle patterns, you need to understand that I have attempted to accomplish all of these things in a static mode, predicting what I believe will be the most likely outcome over the next day or two or three or four. Now, anomalies, data, earnings, crisis events, whatever, assassinations, wars, Martians, those things I can't predict and I won't try to predict. So those are the things that normally send the price data, you know, directionally away from what I'm predicting with my SPY cycle patterns. And again, this is to try to help people understand what's actually taking place. I hope this has been informative. I hope it's been, instructional. And remember, you know, if you ever try to do this, I built a few of these. I built maybe 10 or 15 inference engines in my lifetime. They're not easy, and they take a lot of work. But remember, once you get it down to the point where you're honing in on this last little bit of data, which is the calc data and the anomaly data to try to get the inference engine to work properly, at that point, you're really in the nuts and bolts of everything. That's really how it gets down. Okay, 32 minutes. Didn't mean to take so long, but at least this will be a pretty solid outcome for you. And take a look. Let's see what the SPY is doing. Ripping. Remember, today is a rally day, predicted more than 2 years in advance, and in carryover mode, predicted more than 2 years in advance. This is all based on current price trending. But gotta love it when the SPY cycle patterns are predicting a rally, the market gaps up and rallies like a champ. So we'll see how it plays out. I'm going to end this video here. Remember, follow my videos and play along. I'm trying to help you guys. If you don't like what I do, move on. It's simple. You don't have to follow me. You don't have to get involved. If you don't think this is helpful or informative or going to help you trade, there's lots of other people out there with other opinions. Okay, man. Talk to you later.